Hello and welcome to Taxes in 10, where we take a tax topic and break it down in about 10 minutes. My name is Mark Barnes, and I'm the managing partner of Copper Canyon Tax and Accounting Services in Tucson, Arizona. We are a boutique firm that specializes in small business accounting and taxes. This episode is on reconciling book to tax and Schedule M1. When preparing a tax return for a corporation or partnership, there are adjustments that need to be made to the income reported on the Statement of Revenues and Expenses, also known as the profit and loss. What are separately stated items? These are items that retain their character or need to be calculated at the individual level. Instead of affecting income or expenses of the entity, they're passed through to the owners separately. Some examples on an S Corporation K1, Box 2, Net Rental Real Estate Income. Revenue and expenses go on Form 8825 of the entity return, flow to Box 2 on the K1, and are reported on Schedule E of the individual return. Boxes 4 and 5, Interest Income and Dividends. They retain their character on the 1040. Boxes 7 and 8, Short-term and long-term capital gains, also retain their character on the 1040. Box 11, Section 179. It has an individual limit. Deduction taken at the business level is passed on to the shareholder, and the limit is calculated on their individual 1040. Why are separately stated items important? They are going to affect our income tax return. They appear on Schedule K, which is our starting point for reconciling Schedule M1. What is Schedule M1? M1 is where we add back non-deductible items. It is where we make adjustments for items on the books but not on the tax return, like prepaid expenses. It is where we make adjustments for accrual to cash conversions. It is where we make adjustments for items on the tax return that aren't recorded on the books, like depreciation. And it is where we record adjustments for federal income tax due on a C corporation. Is Schedule M1 always required? For a corporation, Schedule M1 isn't required if both the following are true. Total receipts for the tax year were less than $250,000, and the total assets at the end of the tax year are less than $250,000. For a partnership, Schedule M1 isn't required if all of the following are true. Total receipts for the tax year were less than $250,000. Total assets at the end of the tax year were less than $1 million. Schedule K1 are filed with the return and furnished to the partners on or before the due date, including extensions, and the partnership is not filing and is not required to file a Schedule M3. Please note, in my office, we will not prepare a business tax return that does not have a full set of reconciled books, and every return leaves with a Schedule L and M1 completed, required or not. Let's take a look at Scenario 1. On my work papers, I mark all of the items that appear on Schedule K or create adjustments from book to tax. Item 1 is charitable contributions. They are added back to income, adjusted on Schedule K, and the deduction is taken on the personal return on Schedule A. Item 2 is half of meals. Since these are non-deductible, they are added back. They are adjusted on Schedule M1, and they affect the basis calculation. Item 3 is interest income. This item is subtracted from income, adjusted on Schedule K, and is reported directly on the 1040 as interest income. Here's how our work paper looks. Remember, your adjustment will be the opposite of what has already happened. Remember the bottom figure, $40,440. It is going to be the ordinary business income on our 1120S or 1065. It is also the starting point for Schedule K. Ordinary business income plus or minus items that appear on Schedule K, lines 1 through 14, become the basis for your Schedule M1 reconciliation. In this scenario, the $40,440 ordinary income plus $2 interest income minus $833 charitable contributions equal $39,609. Here is how our M1 looks. Notice that the $39,609 is the income or loss from Schedule K, line 18. From there, we need to make adjustments for items that affect basis but are not separately stated items. We don't report half of meals anywhere on the 1040 or accompanying schedules. That gives us a total of $39,016 per books and ties back to our financial statements. Let's take a look at Scenario 2. This one starts off with the same three adjustments from charity, half of meals, and interest income. This taxpayer maintains accounts receivable on their books, presents financial statements that include accounts receivable, but reports taxable income on a cash basis. Each year, we need to make 2 additional adjustments to his work papers and to his tax return. Item 4, we add back the prior year accounts receivable ending balance. Item 5, we subtract out this year's ending accounts receivable balance. Our adjustment to net income is the difference between the beginning and ending accounts receivable balance. For this particular year, our net adjustment is a negative $48,225.51 since their accounts receivable balance grew significantly. You can verify the revenue amount by adding all of their deposits on the bank statements. Our income per books is $188,676, and our taxable income is going to be $141,113. Hopefully you can see the notations written in green. Here is page 1 of the 1120S that shows our ordinary business income of $141,113, which ties back to our adjusted balance on our financial statements. Our Schedule K reconciled income or loss is $141,015, which is our ordinary income plus $2 interest income minus $100 charitable contributions. It's very important that you close your client's books, and if they are maintaining accounts receivable or accounts payable, it becomes even more critical. Retained earnings will never match if they are constantly making adjustments to invoices in either system. Here is how our M1 looks. Notice the 3 adjustments match the adjustments we made on our work papers. We have our adjustment to basis on line 3B for half of meals. We also have an adjustment on line 2 for our beginning accounts receivable balance. Statement 25 says beginning accounts receivable balance. On line 5, we are taking a deduction for the ending accounts receivable balance. This reconciles out to $188,676, which ties to our financial statements. The reason we are making adjustments on the M1 is because we did not make adjustments on the books to remove the accounts receivable balance. I've seen people try to do it on the books, and it creates a mess. Just make the adjustments on the tax return, and life is good. Our financial statements match, our retained earnings match, the client recognized income based on how they were taxed, and we didn't have to create vendors or customers on the books called adjustments to AR or AP. Let's take a look at Scenario 3. Our first 2 examples were pass-through entities. This example is a small C corporation. You can see that we have 3 adjustments: non-deductible entertainment, half of meals, and non-deductible charity. Their charitable contributions were made to a private GoFundMe campaign, not a qualified 501c3 organization. Note, this client does not accrue income tax throughout the year, so no income taxes are deducted from net income. If they were, you would need to add back federal taxes taken as a deduction, as they are not deductible, just like federal taxes are not deductible on your personal tax return. We have two calculations to make here. Let's break them down. For books, we have two adjusting entries that need to be made. We need to calculate federal income tax and Arizona state income tax. For book purposes, we need to make an adjusting entry to record both federal and state taxes due, debit tax expense, and credit income tax payable. On the tax side, we need to add back items 1, 2, and 3. We have a net income of $8,063.70. That net income results in federal taxes due of $1,614 and Arizona taxes of $377. The $377 is deductible, so our 1120 will show net income of $7,686.77. Here is our first page of our 1120. Line 28 is taxable income. That number includes the $377 in state tax. Line 31 is our federal tax due. My client paid $2,000 in estimated payments, which results in a refund of $386. On our M1, we can see the taxable income on line 10. To get there, we need to add back federal taxes on line 2, half of meals and all entertainment on line 5C, and non-deductible charitable contributions on statement 16. You can see we have a $1 rounding difference on line 1. Keep in mind, I sent adjusting entries to the client, and the adjustments for income taxes are on the books. They are just not present on the financial statements prior to completing the tax return. Always work with your clients to make sure their books are accurate and make sure they close and password protect each period so adjustments cannot be made once the tax return has been prepared. Make sure to hit subscribe to keep up to date on all of our Taxes in 10 video series. If you are interested in earning continuing education on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4 hour on-demand webinars will focus approximately 75% of each hour educating theory and regulation and 25% of each hour on procedure with real-life examples and walk you through completing the necessary forms to increase your potential.